Hood is drifting into earnings week with a possible government shutdown, a Fed rate hangover, and an options chain acting like it knows something the chart refuses to say out loud. This is all happening right now, and somehow the candles still look calm. Welcome back to Fintech Spy, where we analyze, overanalyze, and immediately regret trusting quiet markets, not financial advice. Ever. This is your Robinhood technical read for January 28th, 2026. And this week isn't about flashy headlines or analyst hot takes. It's about tension. On the surface, Hood looks controlled. Analysts are silent. Filings are quiet. And price is moving just enough to keep people staring at their screens without actually rewarding them. But underneath that calm, the setup has been slowly tightening in a way that feels familiar if you've watched this ticker long enough. Last Sunday, Hood looked like it was setting up for a polite bounce. Momentum was cooling, indicators were resetting, and the chart had that maybe next week energy traders love to narrate into existence. 3 trading days later, it still looks like that. And that's the problem. When nothing resolves, positioning starts to matter more than patterns. And that's where this episode lives. On the analyst side, it's still radio silence. No upgrades, no downgrades, no brave soul stepping up to plant a fresh flag ahead of earnings. At this point, that quiet doesn't feel neutral. It feels deliberate. This is the part of the cycle where analysts tend to wait for earnings, a decisive candle, or someone else to say something dumb first so they can react instead of lead. Silence here isn't a lack of opinion. It's risk management. The news flow isn't doing much to break the stalemate either. We've got macro noise hovering over the week, with a possible U.S. government shutdown lining up uncomfortably close to earnings and a recent Fed rate decision already shaking risk appetite. Robinhood itself hasn't dropped any fresh filings, but Vlad Tenev did resurface the GameStop conversation on X, arguing that tokenization is the only real way to prevent another episode like that. It's a very on-brand reminder that while traders are focused on the next candle, the company is still thinking about market structure and long-term plumbing. None of that moves price today, but it adds to the sense that this week's move, whatever it is, isn't coming from a press release. It's coming from positioning. Zooming out to the weekly chart, the story hasn't changed. It's just gotten more uncomfortable. Hood is still consolidating, but it's been stepping down over the past couple of weeks instead of ripping or collapsing. Last Sunday, the weekly read felt constructive. MACD was drifting toward neutral, stock RSI was already oversold, and the 50-week EMA was slowly walking up toward price like it wanted to be involved. Fast forward to now, and MACD is still heading lower instead of flattening. Stock RSI isn't just oversold anymore, it's basically pinned to the floor. The 50 EMA is still approaching, but price hasn't bounced yet. Technically, this is still a setup that could resolve higher. Emotionally, it feels like the market is telling traders they might be early but not necessarily wrong, which is the most annoying thing a chart can do. Every additional week that passes without a bounce doesn't break the setup. It just increases the number of people second-guessing it. Historically, that's the environment where Hood likes to stop being polite. The daily chart is where last Sunday's optimism quietly got exposed. Coming into the week, the daily looked like it was flirting with reversal energy. MACD was close enough that people started counting confirmation days. Stock RSI was trying to lift out of oversold territory. The 50 and 100 EMAs were compressing just enough to spark the usual crossover incoming commentary. Instead, MACD kept slipping lower day after day. Stock RSI never followed through. Price lost the 50, slipped under the 100, and then dipped right through the 200 EMA. Rather than reclaiming fast averages, Hood started leaning on the 200 like emotional support. What's important here is how that happened. This wasn't a violent breakdown. Price approached the 200 EMA, dipped under it briefly, and then stabilized. That doesn't read like panic selling. It reads like indecision with consequences. Even more interesting, the 50 and 100 EMAs are now sitting within about 50 cents of each other, compressing again, but at a lower altitude. The daily chart isn't screaming bullish or bearish. It's saying the reset already happened, and now the market wants proof. That's not a comfortable place to trade. If the daily chart feels indecisive, the 4-hour chart feels tired. Last Sunday, this time frame looked like it was almost ready to lead. MACD was drifting toward positive territory. Stock RSI was cooling from overbought, and candles were shrinking in a way that usually makes intraday traders lean forward in their chairs. Now, MACD has rolled back negative. Stock RSI is fully oversold and reset. Candles have gotten even smaller as the week has gone on. This no longer looks like momentum building. It looks like momentum waiting for instructions. The 50 EMA on the 4-hour is still acting as resistance, sitting above price and quietly reminding everyone who's in control. For intraday traders, this is the worst kind of environment. It's too choppy to trend, too compressed to ignore, and too slow to feel rewarding. The 4-hour keeps hinting that a move is coming, then immediately asking for 5 more minutes. While the chart stays quiet, the options chain is doing anything but. With January 30th expiration coming up, the market is pricing in an expected move of about $7.36 in either direction. That's not subtle. That's the market admitting something is brewing. On the downside, the largest concentration of open interest is sitting at the $100 strike, with roughly 10.4 thousand contracts. That's not casual hedging. That's traders clearly drawing a line and daring price to cross it. On the call side, the 110 strike leads with just over 10.8 thousand contracts, followed closely by the 120 strike with nearly 8.9 thousand. Compared to Sunday, conviction has grown on both sides. Puts built, calls built, direction didn't. That's not fear, and it's not euphoria. It's commitment without agreement. Options traders aren't saying they know what happens next. They're saying they refuse to miss it. Historically, that's when Hood stops being quiet. So what do you think this is? Is Hood setting up for the kind of bounce everyone's too scarred to trust? Or is this just another calm stretch before the chart finds a new way to punish patience? Drop your take below. Bull case, bear case, or emotional support memes all count. If you enjoy overanalysis, market psychology, and laughing through the discomfort, hit the like button, subscribe to the channel, and share this with someone who still thinks oversold means immediate bounce. Big picture, Robinhood doesn't look broken. It looks undecided with consequences. The weekly is coiling near the 50 EMA, the daily reset without follow-through. The 4-hour is exhausted, and the options chain is louder than all of them combined. Someone's going to be right this week. Someone else is going to learn something. And as always, this is not financial advice. This is Fintech Spy.